Hello everyone, once again welcome to KU Padashala. In this video lesson, I am going to discuss income tax planning and management and its associated terms like tax evasion, tax avoidance, etc. See, what is tax planning? Income tax planning is highly significant as far as assessee is concerned. Normally, an assessee will go in touch with the different provisions of the income tax laws. Accordingly, he calculates his total income and pay his tax. Income Tax Act is very specific in providing different types of concessions, deductions, rebates, relief, etc. So, an assessee is always go for availing all these concessions. Number of exceptions are available under section 10 of the Act. Exempted incomes are normally given under section 10 of the Income Tax Act. Number of deductions are available. When we calculate the income under different heads of income, some deductions are available, and from the gross total income again some deductions are available. We have rebates and relief under Income Tax Act. So, an act of availing all those exemptions, deductions, rebates and relief permitted under the Income Tax Act within the purview of law, so that an assessee is able to reduce his tax burden. This is called income tax planning. So, an income tax planning is done within the four corners of law, within the purview of law, by observing all the provisions, all the rules of taxation laws. How an assessee can avail those exemptions, those deductions? The full advantage of these exceptions, deductions, rebates and relief can be availed if he systematically plans his financial activities. So, tax planning is done by making arrangements of one's financial affairs without violating legal provisions of the Act. So, the main focus is on arrangement of financial activities or financial affairs of a person. We have to plan our income, we have to plan our expenses, our investments, so that we can avail those exemptions, deductions, rebates and relief available under the Income Tax Act. This is what is called income tax planning. When we go for planning our income and thereby reducing our tax liability, what is the after effect? Or whether it affects adversely the legislative intent or the objective of taxation. To some extent it is yes, but the lawmakers are very particular in providing these concessions or these deductions. Why? Because even though tax planning reduces the state's share of revenue, it has some positive effect on economy, because we can avail these benefits when we move in line with the law. If we move in line or in touch or in tune with the law, what happens is more investment will be the result. Proper channelization of capital to the priorities sectors will happen. It will lead to better standard of living of the people, and the after effect is social welfare. That is why these different types of concessions are provided in the Income Tax Act to permit assessees to exercise their right of planning their income. So, let us move on to objectives of tax planning. What is the need of tax planning? When we go for planning our income and income tax, the main purpose is to avail the explicit benefit of law. I told you, income tax law is very particular in providing those exemptions, rebates, relief, etc. So, the main purpose of tax planning is to avail these benefits offered by law or lawmakers. When we avail these facilities or these benefits, normally we can reduce the burden of tax. So, the ultimate purpose is reduction of tax liability. Third objective is minimization of litigation. See, there is a conflict of interest between assessees or taxpayers and income tax officials. Assessee is interested to reduce the burden of tax to the maximum extent possible. At the same time, income tax authorities are trying to collect maximum tax from taxpayers. If we move on or move in tune with or in line with the various provisions of the Income Tax Act and rules, there is minimum litigation. So, tax planning is done with the purpose of reducing litigation or minimizing litigation, because it is done within the purview of law, so that litigation can be minimized. Then productive investment. Why we go for tax planning? We have to make productive investment. We take investment decisions based on proper analysis of various provisions of law. So, for that we need to have better understanding of the various provisions of income tax law and rules, so that we can take efficient investment decisions, optimum investment decisions. So, it will lead to productive investment. Then reduction of cost. Why reduction of cost happens? As far as a business is concerned, when an individual business or in a corporate business, what happens is they try to reduce tax through planning their income, expenses, etc. So, what is the after effect? One of the important tax is one of the important expenses. So, they reduce the tax burden. Ultimately, the total cost will reduce. At the same time, sales can be increased. So, it will give better profit or the better trading result or operating result. Healthy growth of the economy. See, normally these are associated objectives When there is productive investment, reduction of cost and better result, the after effect is healthy growth of the economy, economic stability, and it generates more employment, because more and more investment will come, generates more and more employment. So, these are the different purposes with which tax planning is effected, or these are the benefits of tax planning also. See, coming to types of tax planning, these are the different 4 different types of tax planning. Short range tax planning, long range tax planning, permissive planning, and purposive planning. What is short range tax planning? Tax planning effected by an assessee from year to year basis. Actually, what happens is, an assessee goes for tax planning at the end of the financial year in order to arrive at some specific objectives. For that, he makes some kind of investment, normally at the end of the year, so that he can reduce the burden of tax. So, it has no long term impact. The benefit will accrue in the short run normally. This type of tax planning is called a short range tax planning, effected normally at the end of the financial year, and is done from year to year basis. So, coming to long range tax planning, it is undertaken by an assessee, and the benefit will last for long. Normally, it is done from the beginning of the financial year on a continuing basis. Its impact will stand over and over for years. Take an example, you take a housing loan to avail the benefit of interest on housing loan, as well as principal repayment, etc. You will get the benefit for a long period, and it is a well thought out plan as far as an assessee is concerned. You can make investment in equity or debt. It is done with a purpose. If you are investing in equity, you can save tax. It is a long term, it will have a long term impact on your tax planning. Then permissive tax planning, the very name tells its meaning, tax planning made as per the explicit provisions of the taxation laws. So, assessee is moving in line with the various exemptions, deductions, rebates and reliefs available under the Act. Accordingly, he makes planning of his income and tax. Purposive tax planning, again the word tells its meaning. Assessee is making plans with a specific purpose in mind, so that he can avail the benefits under income tax to its maximum. There are different instances or different areas where purposive tax planning is effected. When you go for making an investment decision, when you go for identifying a suitable program for replacement of asset, a depreciation method for availing replacement of your asset, or when you go for leasing of asset instead of owning and maintaining this asset, etc. These are the instances of purposive tax planning. Shall move on to precautions in tax planning. What are the safety measures normally an assessee should take while going for tax planning? First is require proper analysis. Since economic decisions are taken as part of tax planning. Every economic decision, particularly investment decision, should be taken based on proper and intelligent analysis. For that, we need a kind of knowledge base, particularly the different provisions of the taxation laws. So, a better understanding of the taxation laws should be needed to understand the implication of a particular investment or financial decision of the assessee on tax. So, when you go for tax planning, you need to make proper analysis. It cannot be attempted in isolation. What does it mean? Tax planning cannot be done only by considering what is there in income tax law. If we go in that line, what happens is you will get some benefit as per income tax law, but you have to pay some more tax on the basis of some other laws like wealth tax, etc. So, we cannot plan income tax in isolation. We have to consider related knowledge base so that income tax can be planned effectively. Should view all direct tax laws. So, tax planning should not be based on tax avoidance. When you go for tax planning, you should not try to take advantage of loopholes of law or absence of law. Should go in line with income tax laws, or with you do your tax planning effort within the purview of law. Then tax planning is not possible without tax management. Tax management is an associated term which we will discuss in detail later. But tax management means compliance of law. See, a taxpayer has to comply with the different activities necessitated in the administration of income tax in the country. So, it will when we comply the provisions of the act, the after effect is we can reduce different types of fines, penalties, etc. that are attracted due to non-compliance of law. So, tax planning is not possible without tax management. Tax management is what is the real beginning of tax planning. Then tax planning should not be based on case laws. Why? Case laws represents judicial decisions. I told you in different occasions court of law interprets different provisions of the Income Tax Act that forms judicial decisions, normally forms one of the sources of taxation law. But if we plan our tax based on the case laws, what happens is the lawmakers will come with new amendments. When amendments will come, what happens is the benefit is will cease to exist. So, no longer we can avail the benefit of such planning. That is why tax planning should not be based on case laws. So, come to an associated term, it is tax evasion. Tax evasion means dodging of tax, means avoiding of tax by illegal means. How tax evasion is done by an assessee? If he conceals his income or he hides the actual information regarding his income or makes false claims on income and expenses, he can reduce the burden of tax. It is called tax evasion. But it is not in conformity with the provisions of the Income Tax Act and rules. So, it is illegal, at the same time immoral, unfair, antisocial and anti-national. How a person goes for tax evasion? He is trying to suppress actual facts, makes falsification of accounts or records, committing downright frauds and collusions. In that way, normally people commit tax evasion. But income tax and other direct tax laws have made us very strict provisions to deal with this kind of practices, and offending people are punished normally with heavy penalties, fines, etc. So, tax evasion is a method of dodging tax by illegal means. See, what are the different practices normally employed by assessees to evade tax? Omitting to record sales. See, one can reduce the burden of tax either by reducing his total income or by inflating his expenses, his allowable expenses, particularly from the point of business units are concerned. So, these are the different practices normally employed by business people in order to evade a tax. Omitting to record sales means sometimes they are not billing their sales, or they are billing sales for a lesser amount than the actual sales. Then false claims on bad debts, expenses, losses, etc. This is the usual practice. Business people normally claim bad debts, and they claim some expenses not actual, and losses also. Non-disclosure of incomes. See, this is the one way normally used by people for our assessees to evade tax, trying to hide their incomes. Claiming losses not actually incurred. Then treating personal expenses as business expenses, or domestic expenses as business expenses. That way one is able to reduce his total income. Then claiming false donations. Donations to approved institutions are available under section 80G of the Act as deduction. So, people try to claim false donations to reduce their income and tax burden. Then hiding capital gains. This is the normal or the frequently applied tax evasion techniques. Even we people normally do is, when we sell our landed property, particularly in urban area, we do not register the transfer in its actual selling price in order to avoid capital gain tax. Involving Benami transactions. Benami transactions are transactions not in the name of the assessee, but in the name of some other person, so that he shifts income from property now transferred, okay, so that he can evade tax. Then by inflating expenses like salary, etc. This is normally effected in done in business by employing relatives or friends, etc., paying higher amount of salary or unreasonable salary. It is also a method of evading tax. Tax avoidance. See, tax avoidance stands in between tax planning and tax evasion. Tax avoidance is an art of reducing the tax liability without actually breaking the law. What is an art? Art is the systematic way of doing a thing in which the skill and knowledge of the person doing the same is reflected on it. Here the taxpayer is if the taxpayer is an intelligent man, he can skillfully reduce his law without tax without actually breaking the law. How it is done? One can reduce the burden of tax by availing loopholes in law. There are number of loopholes in law or absence of law, absence of provisions. Again, by intelligently employing the loopholes and absence of law, one can reduce the burden of tax liability. So, he is not breaking the law. It is a method of bending law rather than breaking it. So, it is against the real spirit of law or the objective of law. In that sense, it is unfair. But we cannot question tax avoidance because they are not breaking the law. So, it does not attract any kind of penalties or similar things when a person is avoiding the burden of tax. So, tax burden is done within the purview of law, but tries to avoid the try to avail the loopholes or the benefit of absence of law. In that way, a person can reduce the burden of tax. It is called tax avoidance. Coming to the last concept, it is tax management. Tax management is the essential part of tax planning. One cannot go for tax planning without tax management. Tax management, I told you, it is concerned with the proper compliance with the statutory provisions of various taxation laws. So, compliance of law is called tax management. See, what are the different areas where tax management is needed? These are the different areas where we have to comply with the provisions of income tax laws. Deduction and collection of tax at source. Income tax law is very particular in stating detailed provisions concerning tedious tax deducted at source. So, the person who is paying different types of income is responsible, is under legal compulsion to collect and pay tax to government's exchequer. See, maintenance of accounts. Law tells different types of documents and records should be maintained, and they should get audited by qualified chartered accountants, etc. So, this is another area where compliance is needed. Then payment of tax including advance tax. Tax should be paid on stipulated dates. When it becomes due, it should be paid, otherwise it will attract fines in the form of interest, etc. Advance tax is normally paid. 15% of the advance tax should be paid on or before 15th June. 45% of the advance tax should be paid before on or before 15th September, 75% of the total tax should be paid in advance on or before 15th December, and 100% of tax should be paid within 31st March. Audit of accounts, I told you. Fulfillment of conditions to claim deductions. If you claim any deduction as part of your tax planning, you are liable to produce the supporting documents so that you can claim deductions. Furnishing of a return of income. Income Tax Act is very specific in telling the dates on which returns are to be filed by assessees. If it is delayed, again it attracts fines and penalties. Documentation and maintenance of accounts, again it is an area of compliance. Then review of orders, notifications, circulars, etc. issued by authorities. We should carefully verify those orders, notifications, circulars. Only then we will be able to avoid fines and penalties, or we can go in line with the specifications or the stipulations issued by the department, income tax department concerned. So, we shall move on to the difference between tax planning and tax management. We know that tax management is an integral part of tax planning, but there are some points of difference between tax planning and tax management. The objective of tax planning is minimize the tax liability or the burden of tax. But the basic purpose of tax management is comply with the legal provisions of the income tax laws and allied rules. Income tax planning is a wider concept. It includes tax management also. But we learned that income tax management is the first step towards tax planning. Tax planning relates to the benefits of future financial activities, particularly our investment decisions, etc. But tax management relates to past, present and future activities. Tax planning is optional. It is not a legal compulsion. If you need to do planning of your investment, your financial activities, you can reduce the burden of tax. So, it is optional. On the other hand, tax management is a legal compulsion. It is a necessity. We should comply with the provisions of the taxation laws. Tax planning leads to major decisions. Its impact will extend over and over for a long period in future. But the scope of tax management is routine and recurring nature. We have to comply with different provisions of the Act on a routine basis. Tax planning is intended to claim exemptions, deductions, relief, rebate, etc. But tax management is intended to fulfill conditions for claiming those deductions. That means we have to fulfill the condition, we have to provide supporting documents in order to claim those exemptions, deductions, rebate, reliefs, etc. provided under the Income Tax Act. So, these are the main points of difference between tax planning and tax management. So, we discussed income tax planning and management and its associated terms like tax evasion, tax avoidance, etc. As far as a taxpayer is concerned, tax planning is highly significant there are different tips and different precautions that a taxpayer should keep in mind so that he can reduce the burden of tax without violating the provisions of Income Tax Act. And he should do tax management so that he can avoid the subsequent fines, penalties, interest, etc. So that the ultimate after effect is this: one is able to reduce the burden of tax. But don't go for tax evasion and tax avoidance. Tax avoidance, even though it is coming within the purview of law, only by availing loopholes and absence of law, but it is unfair. Being an ideal citizen of the country, we have to contribute an adequate amount from our income towards meeting government's normal expenditure of maintaining law and order in the country, to ensure national security, to provide welfare of the people, etc. Okay, thank you.